With the property crisis also came corporate concerns here in China. Lenovo, Tencent, and XPeng all painted a difficult picture for China as a rocky economic backdrop led to slowing demand for some of the country's largest companies. Paul Christopher, head of global investment strategy over at Wells Fargo Investment Institute, joins us now. Paul, great to see you here this morning. Thanks for taking some time. Let's kind of look back at the week that was in China and what that really sets up for what's next to come on a few different fronts. And perhaps we can start with the action that perhaps might take the markets by storm here if there is continued surprising activity out of policymakers in China.
Well, the China story is a difficult one, and it's weighing on investors here in the U.S. right now. It's a familiar story. It's post-pandemic there, right? So if you go to China, you'll see long lines outside of popular restaurants, tourist spots as packed as ever, train and airline tickets harder to come by, the catering business doing really, really well. But what's suffering there is private business. Private business is just not really sure where things are going next. They're struggling to contain costs, to make money. They're struggling to survive rather than to expand. And then there are these problems with the property developers and the local governments that have borrowed so much money to transfer land or I guess transform land into property. So those are the big problems, and those are weighing on China. Trade from China to the U.S. is down as well. That's not helping. And so you're getting this little bit of deflation coming from China to the U.S., worries about debt there. And that weighs on investors here, just as interest rates look like they're set to go a little bit higher. So it's a kind of a typical hand-wringing sort of August, where a lot of people are on vacation and some of the worries start to close in.
Yeah, this always does happen in August, doesn't it, Paul? I heard one commentator this morning compare China in the capital market sense to a minnow. In other words, it's an economic giant. A lot of U.S. companies have been relying on the country for a part of their revenue. But in terms of sort of financial markets contagion, perhaps not as much a concern. Can you sort of put all of this in context for us, how investors should be thinking about the China issue right now?
Well, it's an apt sort of image of a minnow. China, like many developing countries, has focused its rapid growth on a lot of bank lending, and it's government-directed bank lending. So the government tells the banks who gets the money, who gets the capital. They have a stock market, yeah, sure. A lot of that, though, that stock market is run by insiders. Corporate executives. They're the ones who are doing a lot of the trading. Increasingly, international investors have come to that market, but it's a very up and down market, a very volatile market. So in terms of where private firms can get capital, it's difficult if you're not already on the government's list.
And so if we were to look back towards, anything that is similar to or analogous to what China is experiencing right now and try to paint a picture or a correlation, at least, between where other markets in the world, how they reacted back then. Is there any historical correlation that we can point to?
Well, it's a little bit early for that, probably. But one thing that's in the corner of the eye for a lot of investors is whether or not China is following the path of Korea and Japan. Countries that after their respective wars in the 40s and then in the 50s developed very quickly, especially through the use of government-directed bank credit, so government-directed industrial policies. And inevitably, government-directed policies will get some things wrong. They'll put money where it shouldn't be in bad businesses, bad industries. And so the debt gets to be too high, and then there has to be a consolidation. The debt has to be written off. And so that's the concern with China's property market right now, is that there will be debts that the government can't handle. I don't think that's really the case, at least not yet. We've seen this with Evergrande before. I think the Chinese government can do what it needs to do to hold stability there, but they do have some consolidation that they need to do in the coming years if they're going to right the ship in terms of how they use capital and how they use debt in China.
So, Paul, we have seen some recent flows away from China, at least U.S. flows sort of away from China. Do you think that U.S. investors should stay away from investing in Chinese companies, A, and B, should they also be cautious of U.S. companies that rely heavily on China?
Well, it's difficult because of the lack of transparency in China, and now that Beijing and Washington are playing one-upsmanship in terms of restrictions on companies and restrictions on investment, it becomes even more difficult for U.S. investors, any foreign investor, to make an investment in China where he or she kind of has a good idea of what the playing field looks like and how the rules of the game are going to work in the coming years. Having said that, though, there's still a lot of U.S. companies in China. And so let's say there's a retired U.S. investor who wants to maybe play into Chinese growth going forward. It will be a growing economy going forward. One of the ways we've been suggesting is through U.S. multinationals that still have business there. Some have pulled out, many are still there. So that would be a way to let the big U.S. multinational manage the exchange rate issues, manage the labor issues, manage the regulatory issues, which are becoming increasingly onerous. But we're underweight emerging markets right now, including China. That means we prefer to have our money here in the U.S. And to some extent in Europe and in Japan. So we wouldn't be going to China first. I just wouldn't like to rule it out completely.
What do you believe the consumer in China needs to feel in order for spending to really be reinvigorated?
Well, there's a couple of things. One is that property is extremely expensive. And in China, one has to put down a big down payment in order to get the property, the building started. And the property companies right now have a lot of debt. And so it's a very iffy proposition. You give someone a big down payment. Will that down payment turn into a house? An apartment, or will that company just go bust and take your money down with it? So that's one big problem that the Chinese have, the Chinese consumer has. Another big problem is, will the Chinese worker have a wage? Will the Chinese worker have a job? Unemployment, especially among the young, is very high in China right now. And there have been lots of people, small businesses too, that have lost their incomes, lost their livelihoods. And it's not exactly clear how soon they'll be able to reclaim those.